Well, an increasing number of 401k plans are now including target date funds in their investment mix. Now, target date funds move money from riskier investments such as stocks to more conservative alternatives such as bonds closer to an investor's retirement age. Now, the SEC and Labor Department are now looking into changing the rules for these funds following the recent market losses. So will these rule changes benefit or harm investors? Jeffrey Coons was among those who testified at the SEC Labor Department hearings, and he is also the co-director for research at Manning & Napier, which has been managing target rate funds since the 1970s, so you know what you're talking about, of course. Jeff joins us from Rochester, New York. Thanks so much for being with us.
Thank you very much for having me.
Okay, so are these rule changes going to actually benefit or actually hurt the investors in your view?
Well, if we're talking about changes in the requirements for disclosure and communication, we think that's very good for both plan sponsors and participants to understand the target date funds and the differences among those funds. But restrictions or limitations on the investments of those funds, we believe would be a concern. Ultimately, flexibility is very important in managing to a changing market and economic environment.
But describe to us why, because I think what the term is, what, equity limits or something? I mean, why exactly would that hurt the investor? Describe to us some scenarios.
Yeah, most importantly, we simply don't know what the market environments are going to be like going forward. Much of what we're talking about is reacting to one of the worst bear markets that we've had in history. But if you begin to put limitations on equities now, pushing equity exposure down after that large bear market, you are selling down at a lower level.
Okay, and that means that you're not able then to also make up any gains going forward as well to try to make up for those losses. And Jeff, in your view, is there anything aside from regulation that the target funds or the target date funds can do themselves in order to limit those losses going forward?
Well, I think the most important thing is to take advantage of flexibility and to proactively adjust your allocations to the environment. We believe diversification alone isn't enough to manage risk. It's very important to be able to look at the investments, the return potential of those investments, and only bring them in when those returns offset the ultimate, volatility and risk of those investments.
Okay, and Jeff, just really quickly, I mean, how diverse are these funds? Are they almost all the same, or what?
They're all very, very different. You find, even though they may have the same name, 2020 or 2030, that some of them use index funds, other ones use active management. Some of them are diversified into many different asset classes. And so ultimately, communication of what that strategy is important.
Okay, Jeff, out of time, but thanks so much for joining us on this. Jeffrey Coons, co-director of research of Manning & Napier, and we will be back on Bloomberg News with more on the ongoing investigation into Alan Stanford.
Isn't it times like these that reminds us of what's important? The people in our lives, the ones we love.